Hi, I'd like to talk about two important financial challenges. The first being the evolution with time of a portfolio's probability of return. We know we can do that with Monte Carlo, but the challenge is to do it without Monte Carlo with a closed form solution. And the other challenge is to determine investors' value at risk relative to a risk-free investment. Spoiler alert, it's not zero. Now, this analysis was presented at the academic session of the Financial Planners Association in Chicago last year, but I'd like to just cut to the chase and show you the results of what this analysis can do. As I say, we've met both challenges without Monte Carlo. We know that if we have a probability distribution, it's typically characterized over 1 year. So the portfolio might have a return of, if you put in $10, you might get 11 out, you might get 12 out, you might only get $9 out. And that's the heart of modern portfolio theory when it comes to the probability of a portfolio's return. How about after N years of compounding via the stochastic process of the stock market? And how about with annual contributions or withdrawals? What does that probability distribution of the portfolio's return look like? It's going to be log normal. There's analysis out there in the literature with the Brownian motion of stock prices that will show you that it's log normal. But that analysis does not account for annual contributions or withdrawals, which this analysis does. So let's look at how this analysis can be used and implemented. You can put this closed solution into a Excel calculator, which I've done, and let's look at what some of these inputs to that calculator are. So we're going to have the arithmetic mean of the annual growth rate in equities and its standard deviation, maybe 11 and 19. Fixed income, maybe 3%, standard deviation of 6. Correlation coefficient between the two from -1 to 1. Let's just say it's 0 here. Let's say the goal is $200,000. The investor is saving $7,000 a year, starting with $50,000 and a time horizon of 10 years. So this is basically a scenario of saving for a single child's education. And the allocation between stocks, equities, and fixed income is 80-20. Put that in, and immediately the closed form solution provides the results. There's a 41% probability that the goal will not be met. And at the 75, 50, and 25% chances, these are the numbers. And the calculation provides the closed form solution of what that cumulative probability is relative to the final net worth. And again, if we were shooting for $200,000, we have a 41% chance that we will not get there. So this information can be used by the investor. It shows the full probability distribution, a lot more useful than a single number compounded simply, which really is an incorrect way to look at the evolution of that return with time. Let's look at the investor's value at risk. Now, big IVAR, if you just look at what IVAR is, it's based on a time period, a confidence level, and the loss amount that could occur. With this IVAR concept, it's the probability that an investor's portfolio will underperform a risk-free investment if both are held for N years, and the amount of risk in underperforming that risk-free investment. Again, with this closed form solution, this can be easily done. Let's look at what the inputs might be. Now here, we've taken a more conservative look at what the stock market might provide. And again, all these inputs are user defined. So let's just say it was going to be arithmetic mean of 8%, same standard deviation. We're going to invest everything in equities. So the arithmetic mean of the fixed income is not going to come into play. But we're going to say that the risk-free return is 2.5%. And we're going to look at what happens to $50,000 over 5 years. So fairly short-term comparison of this portfolio to a risk-free investment. And what the closed form solution can provide, well, obviously it's simple to calculate what the risk-free total value would be. That 50,000 will grow to about 57,000. The probability of this portfolio underperforming that risk-free investment is 34%. And when it does underperform, you can simply, since we have a closed form solution, integrate these values here, and come up with what the value is when it underperforms. So the value at risk is $4,500. Of this $50,000, there's a 34% chance that that investor might lose $4,000. When it overperforms, the portfolio overperforms the risk-free, the number is going to be about 78,000. So the upside value is $21,000. So there's a 34% chance of losing $4,500 and a 66% chance of an upside value of $21,000. Again, the investor can put in the time period of interest and what they believe about the risk-free and their equity returns, and really get to the heart of what's known as the equity puzzle, and put it in concrete black and white terms for the investor and his or her financial planner. Now, we're talking about this idea of the equity puzzle. It'll be interesting to see just what happens if we long-term investment. So let's just take everything the same, but go to 20 years instead of 5 years. Now, what you can see is that the risk-free would have grown to $82,000. We still have about $5,000 here, $5,600 at risk, but the upside now is $160,000. So there's an 80% chance that we can exceed the risk-free by $160,000. There's a 20% chance that we will underperform the risk-free by $5,600. Again, a very stark way to look at the equity premium puzzle in black and white, and put it in front of an investor to help make the right decisions for long-term investments, or for short-term investments if they don't really want to lose that $5,000 over that 5-year period in the previous charts. The risk-free might be the logical decision to make. At any rate, these tools are available at this spreadsheet, at this URL. A little long, but if you type that in, you will be able to get to these spreadsheets. But I'd really like to find out other people's opinions about this concept and this approach, this closed form approach to those two ideas. The probability of reaching a certain financial goal and the value at risk that an investor inherently has. Here are my contact information, and I'd love to continue this discussion from an investment point of view and from an academic point of view. Thank you for listening.